Okay, welcome back to Morning Trade Live. It's time now for the big picture. Let's welcome in the team from Charles Schwab. I'm joined today by Cooper Howard, Director and Fixed Income Strategist, Schwab Center for Financial Research, and Michelle Gibley, Director of International Research at Charles Schwab. I will start with you, Michelle, because there's been a lot of attention, obviously, on what is happening internationally right now with what we saw on Friday, hitting the panic button after these threats from Trump. It was interesting, I thought, that he didn't really specify on those tariffs until the markets were closed, but it didn't really matter because come Sunday, he'd actually sort of cooled off and eased up on some of that rhetoric and said, look, everything is going to be fine. So what is your read on everything this morning?
Yeah, I think you're right. We had this escalation in trade tension. It was really kind of surprising because it looked like relations were warming between the two countries. And it might be just posturing by both China and the U.S. ahead of that meeting between President Trump and President Xi on the sidelines of APEC at the end of the month. Beijing clarified that the export control measures are not bans and that the intent was to focus on military use cases. And then Trump over the weekend said that November 1st was an eternity away and the meeting with Xi was still on. We had conciliatory talk by Vice President J.D. Vance and U.S. Trade Representative Jamieson Greer. Both sides are incented to come to a trade deal, but there could be more volatility with potential for both downside and upside until we see either agreement signed or another extension of the trade truce, the deadline of which was supposed to be November 10th, but now it looks like maybe it's November 1st.
Right, yes, so that's what my read on it all was, which sort of brings it a little bit more forward than we were anticipating. So, let's see. Some do believe that China sort of holds escalation dominance here because of what they're doing with rare earths. So I suppose we'll just have to wait and see how things play out in the next couple of weeks. But Cooper, I just want to sort of switch gears and get to you because we're in day 13 now of this government shutdown. Obviously, we're going to be getting that CPI report on October 24th now, just days before the Fed meeting. I'm just wondering how you're reading into everything right now as we look into week 3 of this government shutdown.
Yeah, thanks for having me on this morning, Sam. Really what I think is that it complicates the Fed's job. So without that flow of data that we originally get, it's going to require the Fed to look beyond kind of the common measures that we normally receive, and maybe they'll start to look at some alternative measures. So I think what's also important to look is at the trend of different things. So given that we're starting to see more softening in the labor market, inflation stuck at below or above the Fed's 2% target, that really just complicates and makes their life a little bit more difficult. Also, given the closeness of that CPI report to the Fed meeting, I think that that'll be an interesting thing to see. However, we are going to get a number of different Fed speakers this week, Sam. So I think that that's going to open up the door. If they do want to cut later on this month, then maybe they'll begin to drop a little bit more nuggets. Right now, the market is pricing for that 25 basis point cut later on this month, though.
We're going to be hearing from Powell tomorrow, so no doubt we'll be all sort of eyes and ears. But as you mentioned, the market's still pricing in the chances of a 25 basis point cut to come this month, even without the jobs data, which is the part that they're emphasizing on the dual mandate. Michelle, let's just get out to you again. Curious to get your thoughts. Obviously, we were tracking developments out of Japan last week. It looked like Takaichi was on track to become the first female prime minister, and that was sort of raising some questions about whether we would actually see a shift in policy direction coming from the BOJ with regards to its path to normalization of actually hiking rates. But then that seemed to be all sort of thrown out the window on Friday when we had a collapse of the coalition. I'm just wondering where things stand now and your thoughts on how U.S. investors should be watching this story.
Yeah, I think it matters in terms of the Bank of Japan hiking rates, which is the only major economy to continue to be doing so because inflation is still above 2% and they've been at low rates for such a long time. They're likely to delay their rate hike. They meet at the end of the month. And that could strengthen the yen. And so that has implications for the dollar. And, the Bank of Japan is likely to want more time to assess fiscal spending under whatever the new government looks like. But if they continue to delay hiking, this could actually increase import price inflation and intensify the need to rate hikes. Japanese stocks tend to have a negative correlation with the yen. And so a shift back to hiking rates could strengthen the yen and weaken stocks. Investors might want to hedge currency when investing in Japanese stocks due to kind of some uncertainty about the direction of the yen.
Yeah, no, obviously herein lies why we saw, records for Japanese equities last week, very much on that narrative, moving inversely to that weakening we saw in JPY. Coop, just want to get back to you and shift gears quite dramatically as well once again. And you're sort of looking at the impact of Mother Nature on municipal bonds. I'm just wondering how you're making that correlation, what you're seeing out there.
Yeah, so I think that this is an interesting shift, but we are seeing an increase in the rise of natural shocks or climate shocks. And also we have the nor'easter that's going to hit New Jersey potentially today. So I think that that's where kind of we're looking at this. Also, it's going into hurricane season, so I know many of our investors look at that. But historically, Sam, the muni market's been fairly resilient to climate shocks. We haven't seen any major default because specifically of a climate shock. Now, it does increase some of the costs for municipalities to mitigate against those climate shocks. But the other important piece is once one of those hits, usually it's FEMA that comes in and pays for the cost in the cleanup. Now, if there is a delay in receiving FEMA funds, that issuer, that municipality would be required to pay some of those funds. So if there's a delay or there's potential concerns about receiving funds from FEMA, that would be an issue for some municipalities. I'd be a little bit more concerned about those that are lower rated because they don't have the adequate liquidity or as large of resources to kind of make up for that temporary loss of funding.
Okay, important to keep an eye on. Love the tennis match this morning, guys. Thank you so much, Cooper and Michelle, for joining me today. A really, really insightful. Cooper Howard, Director and Fixed Income Strategist, Schwab Center for Financial Research. Michelle Gibley, also joining me, Director of International Research at Charles Schwab. Appreciate your time.